Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review for the week ending June 23rd, 2023. So maybe just a message to start. I will be leaving for vacation later today. So this is the last review until Friday, July 21st. So the next 3 weeks will be off. So I hope you will be also able to enjoy some good time over the next few months, the next month. I hope that everyone will enjoy the summer and that you're able to take some well-deserved time off out there. So next one, July 21st. Maybe we'll look at the markets this week to get started at the close on a Thursday. So lots of red here. Interestingly, the stock market has been mostly positive and not too volatile over the last few months. So what you see here for equities, it's negative. It's not terribly negative, but that would be the worst week since the month of March for equities. And I'm recording this a few hours before markets open on Friday, and futures are reporting lower. So we could add to that. So maybe we'll have somewhere around minus 1.5 negative on the S&P 500 if we look at the current futures. So let's see how the market evolves today. Higher rates, meaning negative returns on bonds. Central banks are still hiking around the world. I'll be talking about the Bank of England in a few minutes, but still some hawkish surprises from central banks. So higher rates hurting equities. Price of oil down on the week. Chinese data continues to disappoint, but this morning it's more about Europe. One of the strong points of the global economy recently has been the services sector, and especially in Europe, and we just had a negative surprise there. The PMI came out lower than expected, and now it's flirting with the 50 threshold, so anything beyond that means a contraction. So that was the surprise today. The odds of a recession are maybe being repriced into the markets. So this is the story that's unfolding. Canadian dollar, euro higher versus the USD, and the price of gold going down. I usually say it's going nowhere, but now starting to go down. 1914, so 2% pullback on the week. Now, mid-year update for the markets, very succinctly here. So we've been using this chart a few times over the past year. 2022 was an aberration, negative for bonds and stocks. Typically, you have diversification or both are positive. So now we're back into more, usual territory of positive returns on both sides. So equity returns on the vertical axis, horizontal is bonds. You see where 2023 here is here, so the orange dot. It was a strong start to the year for equities. Here it's US data. I think it's likely that we can have maybe some profit taking in the short term. Let's see where we end the year. But diversification again doing its thing. And 60-40 was left for dead in 2022. We were very vocal saying that, well, it was 1 year. It's not a change of these long-term relationships. 60-40 is still an interesting portfolio, and this year 60-40 is behaving very well. But now until the end of the year, if we have some economic turmoil, we could still see good performance from bonds. So diversification remains the key. But 2022 is far behind now. 2023, we're in the right quadrant here. But we're still careful about US equities. We still love equities around the world, but we're more careful about the US. And one way to illustrate it is in this chart here. So maybe I'll take the time to describe it correctly. These are the 6-month change in trailing PE ratios. So it's the evolution of valuations through time. The PE ratios are, how are investors willing to pay? How much are investors willing to pay for every dollar of earnings from businesses? And as you can see, blue line is Nasdaq, red line is the TSX Composite. And Nasdaq 100, I should say, and the gray line is an MSCI ex-US, so the global market taking out the US. And as you can see through time, these things tend to be well correlated, to move together. Going into the great financial crisis of 2008, coming out of it, going into COVID, getting out of COVID, it was pretty much all correlated, so the change in valuations were similar. But now look at the divergence that we have between the Nasdaq 100, and I use the Nasdaq 100 because it's more representative of the most recent themes that were helping the market, the US stock market higher, so AI and tech. And interestingly, when you look at the Nasdaq 100 and the S&P 500, you see that it's mostly the same names that are doing the heavy lifting. So I could have done that with the S&P 500, but I wanted to focus here on what's been really pushing the markets lately, and you have more of that in the Nasdaq 100. And the divergence that we've seen recently is noticeable. So these things tend to converge through time. So will we have a melt up in global equities, and we have all of the markets that converge towards the change in valuation in Nasdaq? Not very likely, but it's a scenario we need to consider. Or maybe we have the Nasdaq 100 that at some point, there's some profit taking, there's a rotation in the market, and going forward, you will see an outperformance of global indices, more value indices like the TSX versus the very growthy Nasdaq 100. So it's more what we expect. So that's why we are almost neutral on equities. We have a slight tilt towards the defensive position with a slight underweight, but this underweight is in the US. It was not the right thing to do in H1 of 2023, of course, with this outperformance here. That surprised us, but looking forward, we still think that's the right strategy to be concentrated outside of the US in equities and have a slight underweight in the US. So that's what I wanted to share here. Now going to central banks, it's now 3,740 basis points of combined hikes or cumulative hikes from the 10 largest central banks since they got started in March of 2022. This week we still had some surprises. Bank of England is fighting inflation that is an outlier in developed countries, much stronger than elsewhere, pushed by wage growth that is stronger than elsewhere. So they're really accelerating here the tightening with the 50 basis points hikes. So they surprised the market. What you see on the chart on the bottom, the countries that are in bold, you have Norway, also that surprised the market with the hike this week. Switzerland, the same thing. So we're close to the end, for sure, but we're not done yet. And you see New Zealand has tightened more than elsewhere. The US is number 2, UK is number 3, Canada is then the number 4. So you see that all of this tightening now, even if they're close to the end of the effort, now the impact will start to appear to be more tangible into the data because of the lags that are long and unpredictable. So H2 2023, H1 2024, likely this is where we will be feeling the bulk of these things. How, when, in what sequence will we see that? Well, that's going to be the stories to follow over the next 6 to 12 months. And of course, we'll be there to guide you through that. So what to watch next week? We'll have the CPI numbers in Canada and the Bank of Canada Business Outlook survey. Last quarter, the survey was in negative territory for the first time since 2020. We'll see if the trend downwards continue, if Canadian businesses are feeling maybe cheerier this time. In the US, we'll have the Conference Board Consumer Confidence Index and core PCE inflation, which is what is followed by the Fed. 0.5% month over month in Canada, 0.4% month over month in the US. That's still too high for comfort. All right, so where to find us? ia.ca/economy. As usual, you have these reviews, you have the podcast as the Economy and Finance 101, but also, again, I want to repeat the new webpage for IA Global Asset Management, iagam.ca/insights. You have lots of content there. From our team, you have the macro and strategy monthly. You have some insights, but you also have some content from my great colleagues. So it's a great webpage to visit. Strongly encourage that you give it a look if you haven't done so already. So thanks everyone. I wish you a happy next few weeks. I'll be enjoying some vacation. I hope you're able to enjoy some vacation too. And I'll be back again on July 21st.